Guys, John Polemy here, Actionable Intelligence. Today is Saturday, July 26th. This is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you personalized individual investment advice. This is for informational purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, just wanted to point this out. Everything's going up. We're in a euphoric market environment. Everybody's making money. Everything seems to be going up. Everybody's a genius now. Everybody's an expert. Everybody's a top-notch investor. I don't say that. I say that with some sarcasm because I've seen this happen before. One of the things that I wanted to point out that I wanted to bring to your attention, one of the factors that I'm seeing as something that indicates to me the bubblicious nature of this market is, we do have the Actionable Intelligence Alert newsletter on Substack. We moved it over there over a year ago. It's working out pretty well. Before that, we had the newsletter was sent out via email and it was very cumbersome. What I've noticed on Substack recently is a huge influx of people writing financial newsletters now and giving financial, I don't want to say advice, but giving market commentary on stocks. I mean, a lot of new people. This seems to me to be an indication of this bubblicious market. People are talking about their returns they've had and, you know, over the last 6 months or a year, and their subscribership is going up massively. And I think that's, an indication of the shiny object phenomenon. If you can find, this is how it works in money management. This is how it works in the newsletter business. This is how it works in all these types of, I don't want to use the word advice, but this kind of industry. It's what have you done for me lately? And, we've talked about in the past the Magellan Fund with Peter Lynch and the fact that he killed the market over a 10 to 12 year time frame where his Magellan Fund returned like 25% plus on average per year. Yet a majority of the people, retail investors invested in the fund, lost money. And that's because people become enthralled, they get their ears tickled, they, jump on whatever's hot and going up. And that's fine. I mean, I'm not here to criticize people. Uh, People can do whatever they want. If they're adults, they can do what they want with their money. They earned it. But I would be careful. One thing I would caution is what you want to see from somebody, you can I read some of the articles and it's like, okay, I'm looking at this particular company that somebody is talking about, and it's mo in most cases it's just caught up in the momentum of this speculative bubble that we're kind of in, that's being fueled by the whole AI thing, by liquidity, by the fiscal inputs that we're seeing, and that's fine. But I want to see what's going to happen. The thing I would ask myself before I would start looking at some of these folks or taking their advice, and I say that with quotations, or if anybody, what's the long-term track record? What's the record through, over several years? Um, are you able to catch a wave in a liquidity and equity bubble, and that makes your returns look good in the short term? What have you done over, 3, 5, plus years? Are you consistently able to deliver market-beating returns? And that's quite difficult. When you're caught up, you can look at go back and look at several equity bubbles or in the past, just in recent history in my lifetime. And we've seen the same phenomenon. Things get hot, people run to it. It's like moths to a light. And again, I don't criticize anyone. This is how I used to operate, but I think that's not really favorable best way to create wealth long term. And but if you're making money, if you're killing it, if going from all these 0 to 3,000 subscribers and 3 months, and what's your previous record? What have you done in the past? Or are you just riding, basically a speculative blow off, top? So I think that's one thing I would just caution people to keep in the back of their mind. I mean, we're at equity speculation levels that are at all-time highs, or at least for the last 35 years. That's usually not a good thing. That usually ends badly. Um, Again, I try not to get caught up in overvalued speculative situations. Um, we try to buy things that are undervalued and re-rate, and that's been successful for me in the long term, and has allowed me to slowly but surely accumulate wealth. I go back to the remembrance of childhood memories of Aesop's fables and the fable of the tortoise and the hare, where the tortoise and hare, I believe it was the hare, challenged the tortoise to a race. And of course, when the race began, the hare or the rabbit took off, you know, and got way ahead of the tortoise because he was super fast, and he became very arrogant and confident in his ability to win the race. And so halfway through the race, he decided to take a nap. But yet the tortoise continued to consistently plod along at the same speed, persevered, continued, and eventually overtook the hare and ended up winning the race. And the lesson is that um, flash in the pan, quick overconfidence sometimes can be will give way to somebody that has a plan and is perseverant and continues on through whatever the you know through any kind of uh, issues or problems. And so these are childhood fables, of course, and there's several meanings in the fable that people have commented on, but that's I think it kind of applies here. We have these speculative eras that happen, reoccur, and a lot of the same mentalities there because you have a new generation of people that don't have the wisdom and experience of the previous bubbles. And so all I'm saying is I would really caution folks to um, pay attention, what, who you're listening to, who you're taking ideas from. Again, basically throwing darts at, you know, the NASDAQ, everything's going up. So does that make you a good investor? Does that make you a good analyst? Does that make, or is it just, everybody is riding a wave now? I mean, my portfolio is doing well too. So everything, when a rising tide lifts all boats, is it the tide or is it your genius that created that problem? If you go through several market cycles, at least a couple, there's a downturn, how do you perform then? That would be the indication. And I think that what will likely happen is a lot of people that are seeing a lot of success or a lot of attention, they may not be able to make it through the downturn when this reverses because all of these speculative bubbles eventually give way. And again, the way that I protect myself, the way that I have found success is to avoid them and to go to sectors that are undervalued. I follow a guy named Steve Blumenthal. I think it's CMG Capital. He puts out a weekly email. You can sign up for it. And one of the things he does is he follows a lot of the information put out by Ned Davis Research. And one of the things that's Mr. Blumenthal will put up on his weekly email about once every couple months, Ned Davis Research tracks all of these various valuation metrics. I think there might be, I don't know the exact number, but something like 20 or 30 of them. It's quite a few. And they'll either be in the red or green and show undervaluation, overvaluation, or whatever. I think the last time I looked at it, a couple weeks ago when it came out, I mean, everything except for two indicators were in the red. That means overvalued or at extremes. Okay, that's not good. You have to be cautious in that environment. And people have the FOMO, the fear of missing out. I mean, this is just one indication. I misspelled market, but this is a S&P 500 price to book value. You're back to levels of extremes that we saw back if you look to the far left, at the dot-com bubble. And these things eventually correct. They do correct. Nothing goes up forever. Now, again, I've said this before, speculative bubble, you can not have any idea how high it's going to go or what the trigger will be to blow it up or what will happen. Right now, as I said, one of the things that I've said is that this is an extraordinary time frame because you basically have all the major governments in the world, at least in the OECD, the developed world, are trying to run their economies hot. Everybody's running it hot because they're so indebted. And so they need to get their debt to GDPs down in nominal terms. So that means raising inflation and getting the nominal GDP to go up. You're at a all-time high in stock markets in the US. You have a 4.1% unemployment rate, and you have the president pressuring the Federal Reserve to cut interest rates. I suspect they eventually will begin cutting interest rates just because we've talked about the federal debt and the interest payments there. But what's that going to do to this speculative bubble? I mean, you already have a ton of liquidity. I mean, money supply is at an all-time high now and going up at 4.5, 5, 6% a year. And then just the big, beautiful bill, all this, running at basically deficit spending levels that are, we haven't seen since World War II when, we were in existential crisis uh, in a world war. Of course, things are going to, if you, it's kind of like during the Reagan administration, they took on a lot of debt. And, somebody said, I think it was in the Congress, Tip O'Neill or somebody, if you let me spend trillions of dollars and go into debt, I can make the economy look good too. So I'm not commenting on whether this is good, bad. I'm just pointing out you have the European Union, China, you have the US. Everybody is going to try to run it hot because everybody's in the same boat. They're over indebted. And so we'll see if it works. But in that type of environment, we can expect to see bubbles popping up all over the place. And so that's just what I want to caution you. This is not because we're in a new era of, you know, if somebody says we're in a new era or this is different this time, I always get nervous because I've studied enough market history and lived through in my investing time um, and been firsthand in major equity bubbles, i.e. like the internet bubble. Now I have no doubt that I'm very bullish on AI as far as how it's going to change things. I obviously I don't think anybody really understands how much it's going to change things, what the impact's going to be. I know it's going to be adopted by every company that can to raise productivity, to lower labor costs. What's going to be the fallout of that? I don't know. Um, and it's going to create euphoria and positive, views towards these companies. But then they get overvalued. At some point, if you're buying something, I've said this before, if the local Dairy Queen went on sale over here and the guy wanted to sell it for 200 grand, I'd buy it because it's fabulously cheap. It's probably doing, 1.5 million or 2 million a year in revenue, and that would be a great price. Conversely, if he wanted to sell it to me for 5 million, I don't want the business. It's overvalued. What's the ability of people forget in these bubbles and in investing in general, they don't understand that a lot of time they're speculating and they're just speculating that they'll be able to get a higher price and sell the security to somebody else. I look at these, I try to at least, and I think the majority of people that, subscribe to my newsletter, what's the actual value of the company? It's a business. I want to own part of this business because whatever it's doing, I think is going to create a sufficient amount of cash flow that can eventually be returned to me via buybacks or dividends or what have you. And so I think that's two fundamental ways of looking at it, where one looking at it as an investor and then looking at it as a speculator. And I don't think that many people understand if they're an investor or speculator. And so, a lot of people will make money. I hope they do. I don't wish ill will on anybody, but be very careful because this is starting to get more and more extreme. And, eventually that ends. And so you don't want to be holding the bag when it does. And the thing about it is I caution. Some people accuse me of like being like arrogant or um, condescending to people. I've made all these same mistakes, guys. I've learned. Okay. Uh, you can't, I guess in some cases, you actually have to go through this sometimes to actually have it, imprinted on your brain, um, so that you don't continue to make the same mistakes. And there's nothing wrong, I think, but as long as you know that you're speculating and that you're sitting on a trap door that could open any minute and drop you into, shark-infested waters, or however you want to look at sitting on a bunch of dynamite with the fuse lit and you don't know how long the fuse is. Whatever analogy you want to use, that's kind of the situation, because paying 100 times revenues for a company, that's not investing. That's just pure speculation. Again, which is fine. Just be aware of what you're doing. And that historically, these valuations typically, when they get extended like this, we always know how they end. So I wanted to put this up. Here's a tweet by this Garrick Morin guy I follow on Twitter. Again, I use Twitter for a lot of things, or X. There's a lot of good information on there. Pointed this out, which I think is interesting, where we're talking about overvalued and things that are popular versus things that are unpopular. It says it's talking about Newmont Gold. They reported earnings this week. So it says Newmont blows away analyst estimates again. Stock closes at 52-week high. Investors redeem another million shares of GDX. GDX being the gold shares, senior gold miner ETF. Shares outstanding fall to another 52-week low, the opposite of a speculative bubble. So you have these gold mining companies, um, that are businesses that are enjoying excessive profits now because the gold price being very high and energy prices relatively have been stable and low, and they're generating tremendous cash flows, and there's no interest in them. There's a small core group of people like myself, but you actually have the amount of shares in GDX going down. People are selling that because I think people are like drawn to whatever, again, the shiny object and what's hot. Eventually, I believe that these companies, these gold mining companies, the ones that are run correctly and are cash flowing tremendously, that cash flow, those streams are going to be recognized of cash flow. And I think we will have a speculative bubble in gold stocks. I don't know when that's going to happen, but I think it will. And this is the type of things that I look for. I don't want to buy Palantir at whatever 100 times revenue or whatever. I'd rather own a company like Newmont currently. Now, that doesn't mean it's a buy and hold for the next 20 years, because mining's not a very good business, and it only works in certain time frames when price of the commodity, kind of like a sweet spot like we're in now. So you have to be cognizant of that. But they're just, I think they're going to generate something around $4 or $5 billion in cash flow this year. And what's interesting is when they bought another company, I'm just talking about Newmont. I think, what was the name of the company? It was an Australian company. They basically took all the assets and uh, they segregated them by like tier one, tier two, and tier three. So they basically got rid of all the tier two and tier three substandard properties, kept all the top properties. Their gold production is virtually the same post merger, but they high graded everything and sold off the other mar less, let's say, I won't say profitable, but lower quality assets. And so they now are enjoying the fruits of these huge cash flows from these tier one assets that they have. So there are good run mining companies that are enjoying excessive profits, but this is an example of, at least with Newmont and the GDX, that's kind of ignored still. So this is Michael Cantro. I follow him. He's a economist, market commentator. He's pretty prolific on X. This is basically sums up what I was saying earlier in the introduction, because everybody is a genius investor when PEs are going up. This is the part of the market cycle where you can throw darts and make money. Trees don't grow to the sky, and valuations eventually stop expanding when macro risks arise. Currently, the markets reflect very little to no risk. Enjoy it while it lasts. Kind of reminds me of the scene in Wall Street, where Bud Fox, there's a character in there, an old guy in the office, and Bud Fox is on a roll. He's doing the insider trading with um, Gordon Gekko, and the old guy comes and, puts his arm around his shoulder and says, you're on a hot run right now, Bud, the guy, Bud Fox, the character of the movie. Um, you're on a hot run. Enjoy it while it lasts because it never does. And so that's basically what I'm cautioning everybody. If you're making money, if you're doing well in this market, which is basically just kind of a speculative bubble at this point, enjoy it. Make sure you understand it's a bubble. Um, the temptation to justify it going higher and higher in your mind because you want it to, because you start thinking that it can never end and what can possibly be. I call it the visions of sugar plums. Just understand that it never lasts. And that doesn't mean it can't go higher. We're at extreme levels now. Can it get more extreme? Yes. Records always get broken, right? Everybody thinks, well, this previous record will never be broken, and then it gets broken. So things can get even more extreme. I just say be careful. So Ray Dalio had a article in Time magazine. I'll put a link to it in the show notes. Basically, the kind of conflict that's going on, this administration basically is just going to push the pedal to the floor and go for it as far as running the economy hot and hope that everything that's going and that we don't have an outbreak of inflation before the midterms. Run it hot. As I said earlier, all governments in the developed world are kind of in the same spot. They all have to get nominal growth to get the debt to GDP ratios down. But anyways, this is some blurbs from his article in Time magazine. Time magazine, I didn't even know it still existed, by the way. I used to read it a lot when I was a kid, but I think it kind of faded away, like a lot of journalistic so-called journalism doesn't exist anymore, but that's another story. But anyways, I thought these were good comments. It says the argument between President Donald Trump and Federal Reserve Chairman Jay Powell is about the value of money. When there is too much debt and borrowing, the classic way of dealing with it is to push real interest rates down and devalue money, which is bad for creditors and good for debtors. That is what Trump is pushing for and what Powell is defending against. Then he goes on to say, I'm jumping around the article here, blurbs. As for the market indicators, they are clearly saying that money is now easy and that the economy is not in trouble because when stocks go up, the value of money goes down. Credit spreads are narrow and real yields are low. That reflects money being easy. So, we have these easy monetary conditions. It's no wonder why uh, assets are doing well. Goes on here. Defending monetary discipline, like defending fiscal discipline, isn't a popular thing to do because it is de facto telling people that they need to have financial discipline. Yeah, everybody wants the good times roll. The politicians want boom times so that they can get reelected. Everybody wants their 401k to go up. Um, Wall Street wants more assets under management to cream off more fees. Everybody is aligned. The incentives are aligned for there to be a boom and for asset prices to go up. And so it all feels good until, as we've talked about in the Cantillon effect, when that, huge ice melt and rain in northern Minnesota in boundary waters, is going to result in the Mississippi River having floods at some point, 2 or 3 weeks down the line. When that's all happening up in Minnesota, there's no effect down in Iowa or St. Louis or Mississippi. But at some point, as that water or liquidity, the analogous to the liquidity starts flowing through the river or through the economy, then that's when you start, seeing the other effects besides just rising asset prices. This is why I said when there's an asset bubble or there's high liquidity like this, you have to be you have to be on the front end of touching it and being affected by it. You don't want to be a wage earner with no assets who's down, at the bottom of the river, who's going to feel the price increases from all the liquidity and money printing. So you want to be the person that's closest to the money printer, as Cantillon said, who's closest to the king back in his time, that had the ability to get closest to the king and the gold. So he goes on to say here at the end, sum it up. So it seems to me that one should keep betting on weak money. That means the dollar and interest rates will likely go down. Yeah, that's what I'm betting on. The president and this administration wants interest rates down. That will be negative for the dollar. They want a lower dollar because they believe. I mean, I heard Trump make a comment the other day when he was, to the press. He was outside the White House going to the heli wherever he was going, and somebody asked him about that. And he said, "Yes, weaker dollar is good for the economy." That's what he said. So Um, that's what they want, and that's their policy. And so I think that's what I'm kind of betting on because I think, but the problem is all the other economies in the world want weak currencies too. They want to devalue their currencies relative to the other currencies so that they can sell things cheaper to other people. So it's this competitive devaluation. And so that's why you have to look not to the Japanese yen or the euro. You have to look at things like what what is the value of the dollar relative to gold, for example, or Bitcoin, or other assets that can't be created out of thin air. So as they increase the amount of currency units, they're not able to just at the New York Fed trading desk just conjure up more oil, barrels of oil, or ounces of gold, or Bitcoins. So that's why you're seeing relative to um, all this other nonsense, you're seeing these other assets are places where stores of value um, will do well. We can look back to the late 70s, early 80s, basically the era of the 70s up until the early 80s. It's going to be, I believe, something similar to that, and the same assets will do well, and that was hard assets. So that's why I continue to be advocate for hard assets as not only a preservation of wealth, but a way to increase your wealth. So I put here's another comment here. Why are people have so much angst? I think I saw something that before the pandemic, 60% of the people were able to, qualify and buy a house. Now it's down to like 40% after the pandemic. Um, Insurance rates, car insurance, health insurance, college tuition, fees, licensing, all these things, prices keep going up. They keep raising prices, property taxes, everything's going up, up, up. So it's creating angst among the population because there's just tremendous need for revenue because of all this government spending at all levels of government. They're experiencing inflation too. So what's their, hey, we got to give raises to the city employees or the county employees. We need more revenue. We need to, do this. We need to do that. We need more revenue. Create another licensing requirement. Create another tax or stamp fee that you have to pay. And it just never ends. And no one ever talks about what's the real role philosophically of government and what should government be doing. Because most people have been brainwashed because they've been in the, establishment created system of the public school system and all these other things to think that, hey, you know, this is what's required for a, quote, civilized society. Okay. And then, but people are being crushed and they don't see the real crux of the matter. They try to blame, everything's really around because the news media drives a tattoo, like, the president, whether it's a Democrat or a Republican, like he's like some dictator that's sitting there making 10,000, 50,000, 100,000 decisions, individual decisions a day on everything. That's not how things work. It's at all levels. And, people just don't want, they want things. Okay. They want services. They want things for free or what they think they deserve. But nobody wants to pay for any of this. And so you create this huge bureaucracy, and it's just the law of bureaucracies. They're not going to shrink on their own. I've explained that before. You talk to any bureaucrat in any department in any level of government, and they always need more money. They could always do more if they had more money. They never go and say, you know what, um, we're fine. We're able to meet the needs, or what's the real need for this? Because if you're the director of the department, you're probably making six-figure salary. You're ordering all these people around. You got a nice pension and healthcare package. Why do you want to shut it down? You have to look at people's self-interests. So getting to this, the angst that people have, why does the average consumer feel worse off? Because 41% of consumer spending goes to housing, utilities, healthcare, medications, and insurance. This was 16% in 1947, 30% in 1980, and 35% in 1990. Fewer consumer dollars are left for true discretionary spending because wages haven't kept up because we have a crooked, backwards, cheating, strip mined, set up to strip mine monetary system of constant inflation, creating currency units. And the average person doesn't have a clue. I pointed it out, I think, a couple weeks ago. What, you know, based inflation adjusted, what should the minimum wage be? $30 an hour. People would scoff. Well, that's too high. But inflation adjusted from like 1980, it's not. So people continue to fall further and further behind. And so what the powers that be, the U.S. Chamber of Commerce, business, I've heard so many people got so addicted to cheap labor in this country from immigration, legal immigration, that their business can't function without the cheap labor. I've seen construction companies, people get on X. I've seen farmers. I've seen all these people. No one will do these jobs. No one will work, you know. And in the meantime, the average person's falling behind. And nobody wants to go through the adjustment period of this. They just want, well, who's going to cut your lawn? Well, go buy a lawnmower and cut your own lawn. Did that ever occur to anybody? Most of the people in the country are overweight. You could use the exercise. I'm being flippant here, but, you know, I think that people have this angst. People can, they don't really know why this is happening. And we have a small group of people that has benefited from this over the last 40, 30, 40, 50 years. And the system now is not able to deliver anymore for the overall good of the people of the country. And so this is why we're, kind of in this fourth turning. I mean, at some point, this has to stop. You can't have, 90% of your income going for you're just working as like a Russian serf for the bare minimum. That Steve Bannon says. Most of the millennials and Generation Z are just going to exist as Russian serfs, never own anything, never have anything, and just work their entire life so they die. This is not what people want. So, the political class, the establishment class in this country is not going to respond to that. It's going to have to very violently happen. I don't necessarily mean out of the barrel of a gun, but a political trauma, upheaval, social upheaval until it changes. Wealth is too concentrated in this country. And it's not go and steal the wealth from the people. It's what are the mechanisms, i.e., our monetary system is a big cause of it, needs to be readjusted. But the average person can't even see it. They don't understand how it works. No one teaches it, no one talks about it. And so my advice is, hey, I hope it changes. Probably won't until we hit the walls at some point. So you have to understand, as I've said before, what are the rules of this game that we're in? I'm not here to change the rules. I need to because you know, I eat what I kill. So I got to be out there understanding how the rules are, and then how do I maximize my advantage or my opportunity. So I want to talk, I talk about the dollar being more weak over time, but you have to be a little bit cautious here in the near term. I've talked about this for a couple of weeks now. This is from the fund manager survey that recently came out. Again, the U.S. dollar is the crowded trade right now, short U.S. dollar. Uh, so everybody thinks the dollar is going to go down. That's the perfect environment for a counter trend rally. I still think in a secular way, meaning long term, the dollar will decline relative to, um, you know, other currencies. And the main currencies that I want to look at is like gold because it's a currency that can't really be devalued like these other paper monetary. So I think, yeah, in the short term, could you have a bounce? Yes. Could you have a counter-cyclical rally? Yes. Things just don't go up or down, straight up or down forever. There's, even in a long-term secular trend, there's cyclical uh, counter trends. I thought it was interesting to see that gold has become less popular, which is interesting. And also, long EU stocks has become less popular. Um, and long global banks isn't even hardly registering. It's just now popped up. We've done fairly well on various banks in Europe. And, as I've talked about before, and I'm looking at other banks around the world. One of the portfolio holdings is a company that's kind of like a Berkshire Hathaway or Fairfax types financial type situation, but it's in the Republic of Georgia. Company's one of its main assets is a 20%. They have 20% ownership of Bank of Georgia, which is actually they changed the name of it. I can't remember, but it's basically the Bank of Georgia, and it trades in London. The Bank of Georgia does, and this entity I'm talking about, and they've just been doing tremendously. They're expanding into Armenia. Uh, Return on equity is great. I'm looking at the Greek bank. I like those. I like those. And a lot of the European banks, people say, well, Europe's a basket case and all this. Yeah, but the problem is that these banks just kept, what were they doing? They weren't making loans for many, many years. They were just, you know, repairing their balance sheets as putting money into government bonds, getting interest. There's an interest rate differential until recently when, the net interest income was relatively high because rates were higher. It's kind of changed since the bank in the EU has cut rates, but they weren't making loans and they were accumulating capital on their balance sheets well above what was required by the regulators. So what have they been doing? Buying back billions of dollars worth of stock, raising dividends, and we're starting to see that around the world. We've seen that in different areas. And so we just try to replicate that. And that's why I'm kind of, Japanese banks, Korean banks, whatever, the pattern repeats possibly. So, um, something to look at. And, again, you look at the fund manager survey, nobody's looking at this. So that's a sector that has done very well. Got, I think, two banks in the dividend portfolio in the Actionable Intelligence Alert dividend portfolio. And I think the one bank we have in there, it's a British bank, based UK based bank. It's the uh, best performer in the portfolio. It's up almost 100%. So, and you're getting increased dividends, and the company continues to buy back shares. That's the whole methodology. That's the whole purpose of that portfolio. Find those type of companies. And so I like to see when nobody else is really in the area where I'm fishing. Only 2% of fund managers are um, uh, think that long global banks is a crowded trade. So I wanted to show this again, top-down charts, one of my favorite sites. This guy puts out a tremendous amount of interesting charts. This is the global equities, 70 countries, main indexes, X the US. So without the US, and we see, obviously, we are seeing a breakout after basically almost 20 years, 15 years, 18 years of basically side to side. After the last run, you see, as I've said before, these global equities will outperform for several years, up to a decade, and then they'll just go into these long periods where they don't do anything. And now we're seeing a breakout from this range. Now, again, some wag will say in the comments, well, you're just drawing crayon marks on a chart. Yeah, I get that, but there's something happening. And we have about, 80% of the global equity markets trading above their 200-day moving average. So something's happening. I still think there's tremendous value in many foreign markets relative to the U.S. Again, the U.S. has remained overvalued. I've been talking about this for a few years. There's undervaluation in many other markets around the world, and I think that it's, a good idea to look into those areas. And I think some of the best performing markets this year are like Poland and Greece, if you can imagine. So I think the Greek ETF is up 50%, something like that this year. So that doesn't mean I would buy it today or on Monday, but that's what I'm telling you. You can look outside um, and give up kind of home country bias and make the world your entire oyster. You can trade all over the world. A lot of securities trade on markets in the US or in the UK that you can trade, ETFs or whatever, companies that are, you know, like I was talking about that company in the Republic of Georgia that's been a tremendous performer for us in the Actionable Intelligence Alert newsletter. And we're going to, there's a lot of opportunity out there. Don't just, you're not wedded to just your home market. So I thought this was important. I don't know if you saw this. This was this week. President Trump signed an AI data center executive order. I pulled a couple blurbs out. I would read the thing if I were you. They're going all in on this AI stuff, data centers, the power plants. This is going to this is leading to trillions of dollars of investment. Again, I don't know if they're going to make any money off at these companies. I don't know what the effect will be, but the money's going there. And what I will say about AI is this: I have no advantage in technology. You know, there's people that are a lot smarter than me that have a lot more and better information on AI, what the latest AI is. You see those little YouTube advertisements about, they're, I don't know, how to make money off AI. And it's like all the boomers know is Chat GPT. And then they go on and trying to entice you into whatever they're enticing you to. But that is actually true. And so, but I do use Chat GPT for equity research and for other deep research. It's phenomenal as long as that you prompt it correctly. And so I can see what's happening, but I am not the guy that's going to go out and figure out what technology company is going to be the leader in this. I look at it from the perspective of, okay, what's the second derivative that I do know something about and I get what they're doing and I understand what the power requirements are and energy inputs. That's where my advantage comes. And so that's what I focus on. I don't need to know which AI model is the top one, which one's going to succeed, which company is going to succeed in the technologies. I understand that if you throw a bunch of servers in there, you need a lot of and chips to run this. You need a lot of energy, and we don't have enough energy. And so that's where I look. That's where my advantage is. That's an area that I actually have competence in and know what I'm talking about. And so that's why I think that's maybe it's not going to give you the same alpha. You're not going to get, 10 baggers and get all the dopamine hits from, things, going straight up. But, you know, without the energy, none of that stuff works. And I don't have to pick the winner technologically wise. So, anyways, getting back to what the executive order kind of says the Trump administration's new executive order signed on July 23rd seeks to streamline the development of large-scale AI data centers that consume more than 100 megawatts of power. That's a massive amount of compute muscle, but it's necessary to train and run next-generation AI models. Trump's executive order also prioritizes projects with 500 million or more in capital expenditures, fast-tracking them through what used to be a years-long regulatory slog. In short, the White House is telling the tech industry, quote, build it and build it fast. And so again, there's the power, the energy doesn't exist. So there's going to be opportunity there. And that's where my focus is. This was from the latest from U.S. Global Investors, the Frank Talks, Frank Holmes weekly commentary. I always love their charts. They're very visually appealing. But anyways, this is the from McKinsey, estimated global data center capacity demand in gigawatts. It's showing AI workload, non-AI workload, 2025. Again, we always have to be careful, as I've mentioned many times before, of compound annual growth rates and assumptions out into the future. But if this AI thing takes hold and the data centers get built, this is going to be the required energy. And so between now, you can see what McKinsey is saying. Between now, basically, you've got 82 gigawatts of yeah, 44 gigawatts of AI workload going, basically going up, you know, four times in the next 5 years. And we're already having problems delivering the power. I talked about what's happening in Pennsylvania. Um, we'll get to that in a minute. So it says AI to drive 165 increase in data center power demand by 2030. Goldman Sachs research forecasts global power demand from data centers will increase 50% by 2027 and by as much as 165% by the end of the decade, writes James Schneider, a senior equity research analyst covering U.S. telecom, digital infrastructure, and IT services. At present, Goldman Sachs research team estimates the power usage by the global data center market to be around 55 gigawatts. This is comprised of cloud computing workloads, traditional workloads for typical business functions such as email and storage, and AI. The AI is only 14% the current workload. Then it says, by modeling future demand for each of these workload types, our analysts project power demand will reach 84 gigawatts by 2027. That's only 2 years from now, 2.5 years from now. So you're going to go up by a factor of 29 gigawatts, 29,000 megawatts in 2 years. That's tremendous. Where are you going to get all the fuel for that? It's not going to be nuclear. Okay, it's going to be natural gas, and many offshore sites, like in China, it's going to be coal. That's why another reason coal demand's at record highs. And so basically you're going to see AI growing to 27% of the overall market, vice the current 14. So AI is going to have an impact. And that's where I want to focus my attention, on the energy sector that's required to power this stuff. So it's finally happening. U.S. oil production is declining, in danger of decline. I think we had the first decline since 2021, which reported by the EIA. I think it was oil production in the U.S. was down like in the last reporting period. This is a comment from Patterson, which is a driller, supplies drilling rigs. Quote, we believe if oil-directed activity does not recover from current levels, we will likely see a larger negative impact on U.S. oil production than we have seen so far, unquote. That's exactly what I think is going to happen. I've been talking about this for a year or more. It's take time, lag effects. It's starting to happen. We're seeing it. The data is unequivocal now. This is from Christine Guerrero. Halliburton production is expected to roll over. It says, this is from, I think, their recent call. Quote, we are below maintenance level in key markets, particularly North America and Mexico. Quote, production is expected to roll over, unquote. This is from HFI Research on Substack. They track all this. You can see this is U.S. crude production composite index. It's plateaued. It's plateaued since basically 2023, and now it's actually showing the decline. So again, we don't know that if higher prices come back, 90, $100 a barrel or higher, something like that, that we won't just see a lot of money flow into these shale basins and then all of a sudden production explodes again. Unknowable right now. But I do think that there's both a financial and geological component to U.S. shale plateauing. That's my view. Piling on top of that, why I'm bullish on oil prices in the future is, you see how OPEC is kind of reasserting itself. Yes, they're bringing back supposedly all this production, but it's not actual barrels in some cases. You really have to read through the line. And you pile on top of that the fact that we're at, record high levels of demand, setting new records every year. And the OPEC General Secretary said that they expect to see oil demand increase by 1 million to 1.5 million barrels a day. That's consistent with what we've seen for the last 40 years, with the exception of 4 or 5 times, which were severe economic dislocations like the pandemic, the great financial crisis. Otherwise, and even when that does happen, oil demand recovers because it's the lifeblood of modern economies and societies. It's just that simple. So I think that I'm seeing more and more discussion around this in the financial press. At some point, this is going to get priced in as more data comes out. People realize that it looks like U.S. shale has peaked. People are going to start looking at, the fact that this was one of the main areas of carrying all of the supply response for increased demand, and that I think the scenario that we were hoping for, which was the underinvestment leading to a supply shock and higher prices, that's now becoming, I think, starting to manifest in the windshield as we go down this road. It's way off in the future a little bit still, but it's getting clearer and clearer, I think. Meanwhile, this is from uh, fund manager survey. Fund managers are underweight energy stocks. You can see they've been that way for years. It says fund manager survey investors are net 23% underweight energy. Energy allocation is up from a record low allocation of 35 underweight in May. Current reading is 1.8 standard deviation below its long-term average. So I think this is going to reverse. You can see the net overweight, underweight. You can see how underweight folks are. I mean, the sector has not performed well, so there's not a lot of attention to it. I think that's going to change. I think that's going to change. We're going to have, you see that, basically since shale kind of exploded and the financial mismanagement of it, where it was drill baby drill instead of focusing on cash flow, the legacy of that. But that's all changed now. Everything that was in place to make this a basically uninviting place to invest is reversing, in my view. So I wanted to talk about these oil sands companies again. I'm very bullish on them. I think you could take a look at them. We've talked about the high reserve life indexes, the fact that their infrastructure has been put into place, it's up and running. There's not a lot of expansion going on. There's no need for big capital investments. Mostly the pointed that out, I think, last week or the week before, showing the cash flows that these things are putting out well above what the maintenance capital is, therefore leading these companies to do what? Return capital to shareholders for via share buybacks and dividends. And so this is a blurb from a whole thing on Twitter, uh, a role that somebody went on talking about the oil sands, but I thought this was interesting. It says, oil sands benefit from geology, technology, and cost-cutting measures, which is true. They continue to cut costs and find more efficiencies. They have lower break-even prices than U.S. shale. So here's the break-even prices in WTI for like Canadian Natural Resources, who I've been pounding the table on publicly on this channel. Uh, their break-even price is basically $41 a barrel. Cenovus is 42, Imperial 42, Meg 42, Suncor, basically 43, and then U.S. producers are what, above 60. So, and most of these oil sands operators have decades and decades of reserves. Okay. And they're not, you know, again, they're not looking to have billions and billions of dollars and go into debt to expand their operations. The stuff has been built as we speak, ka-chunk, ka-chunk, ka-chunk. They're processing these oil sands every day. Cash flow is being generated in excess of what's required to maintain the facility. So it's going to debt reduction, share buybacks, dividend increases, all accretive to equity holders. I think buying a basket of these things, um, you will outperform the S&P over the next 3 to 5 years, in my view. And I think you have optionality towards a higher oil price here, where these things can really get some torque if we see oil prices go up, like I suspect they will be over the coming years. That's why I call them ATMs. They're just going to be spitting out cash like a broken slot machine. So this is what I want to talk about. The executive order to increase the data centers, the billions, if not trillions of dollars that's flowing into the AI sector. I mean, there's not enough power infrastructure to handle this. And that's not something that you can just snap your fingers and do. This is the electricity prices, capacity auction costs. I think they do this a couple times a year. PJM is one of the regional transmission authorities or uh, operators. So it's multi-state. I'll show you a map. It's basically up in the Northeast, continuing, Mid-Atlantic, Northeast, and they basically control the grid in that area. And for example, say you want to bring a wind farm online, like I had to do it in Illinois when I did a wind farm outside of Chicago. It falls inside the PGM authority. So they have rules and regulations you have to meet. You can't just build a power plant and connect it to the grid. There's certain studies that have to be done. You have to submit all this paperwork. It's a process that takes, it can take up to a year plus or more to get permission from the transit because they want to know, is this facility that you're building, first of all, are you going to competently build it? How are you going to build it? Who's building it? What's the engineering? How's it going to affect the grid? How's it going to affect everybody else? Okay, because they have to manage all this. So you have to go through this process. It's very specialized and it's cumbersome and it takes time. And the problem is even before this AI boom, when I was still in the renewable industry a couple of years ago, well, a year and a half ago, whatever it was, people were shying away from trying to do projects in PGM because they had such a backlog. The transmission operator, the PGM folks were so overwhelmed with requests for new generation, basically solar farms and all this stuff, that the wait was unbelievable. They didn't have enough people to do all the work. And so there was a big backlog there. Okay. And not only that, then they have to look at all this. It's like you're going to throw all of this generation online. Can the infrastructure handle it? And so now they do these auction costs for, price of power. And you see just in the last 2 years how the auctions, US per megawatt, I mean, it's soared over the last 2 years. This is being driven by all those data centers. I talked about the other day, like in Pennsylvania, the state government is getting, feeling the heat now from consumers because all this new demand is forcing power prices up for everyone. And I predicted this would be a backlash. This is part of the problem that these big tech companies are going to have to deal with. Okay. They're self-interested to get their data centers online, but the capacity doesn't exist to allow them to do that. Do they necessarily have it in the forefront of their mind of how this, huge data center they want to build somewhere is going to affect, your power prices? No, you know. And so now the government's hearing about it because the state government is like, hey, this is not going to be politically viable if power prices are up. Look at this. You can look at this and see what the outlier is. It's the last 2 years. It's obvious what's driving this. And I've warned about this since I've understood this was going to happen for 15, 20 years. The lack of investment in infrastructure in this country, particularly in energy infrastructure, was going to end up jumping up and biting us in the backside. Now it's happening. But out of this pain, out of this chaos will come opportunity. That's what I'm very bullish about, the opportunity. This is why the executive orders were signed. You know, they're going to allow, trying to fast track everything, but it still takes time. You can't just say, okay, well, I have $1 billion. I'll go build a couple cogens in PGM. You still have to go through the process. And so these prices and I'll put a link to the article or the PGM website. It talked about all this. It's a big, long article. It will, incentives do work. Higher prices cure higher prices. Eventually, the investment will come, but there will be a period of time. And so what happens with are they going to have to do like Musk did down in Memphis with his data center? He just brought a bunch of skid mounted things in and turned them on. And everybody kind of looked the other way. Well, you can't get away with that everywhere. Everybody can't do that, or the grid will become, willy-nilly. You can't, it has to be planned. You have to understand what we're adding, where we're adding it. Is the infrastructure or the substations able to handle it? It's just not, and all this stuff is old. You've driven around and seen some of these substations, you don't pay a second thought to it. You can see this area with all these wires going in and out of it and boxes and breakers and transformers. That stuff's old. And so, it's not been upgraded. And sometimes you have to do a bunch of upgrades. I mean, I've had to do putting a new power plant in place, whether it's a renewable plant or a fossil, you have to do upgrades to transformers and, substations. You have to work with the local utility. The local utility is not entrepreneurial either. You might say, well, we're going to tie into your substation. They have to make improvements. They have to go through the study period. They have to do their paperwork. They have their internal processes. And then you say, well, who pays for it? Well, the ratepayer pays. So, that's all passed on. It's cost plus for the utility. And so they're limited on what they can do. And, how many people actually work in this industry that can go out and build this stuff? Not that many. We've talked about that. Mike Rowe have talked about that for years in the initiative he has to get more tradesmen. There's not enough qualified tradespeople. And so now this is all coming to a head because, hey, go to college, learn to code, get a cubicle job, you know, financialize the economy. Everybody's a financial analyst. There's no need to, go out there and do things in the real world to support any of this because it just is there. As Jay Leno on his jaywalking segments. Where does power come from? I don't know, the plug in the wall. People have no clue how this works. And so now it's manifesting in higher prices and everybody's getting upset, which makes sense because, do you want, you're sitting there, your power bill goes up by, doubles or goes up 40 or 50% in a year. And you're going, why is this happening? Somebody needs to do something. And the average, Joe Schmo has no idea what's driving it, but we do. And this creates the opportunity that we have to uncover and look for opportunities to capitalize. Because this problem will get solved. It's just a matter of enough money and enough time. So here's the PGM area. You can see like when I was working in Illinois, outside of Chicago, that's where we were. Parts of Indiana and Michigan, you see the states Ohio, Pennsylvania, New Jersey, Maryland, basically mid-Atlantic, and then going out towards the Midwest. Then you have over here MISO. I'm not going to get into all of them, but there's like 6 or 8 of them in the U.S. If I remember correctly. But anyways, this is what's being affected. And Pennsylvania's really feeling it. A lot of the data centers are in Northern Virginia, around DC. Okay, so that's why Dominion Power, um, operating down there, they've had a lot of success recently. Constellation Energy operates up in this area. So, um, again, this can be solved, but then, the data center people like Meta and, Alphabet and all these other people, Amazon, hey, we got to get it. We got to go, go, go. And our industry isn't set up to be like that. It's slow. It's more like a tortoise. It moves slowly, methodically. And again, you can't just willy-nilly just start throwing power plants up all over the place or the whole grid will go. You have to understand how you integrate this stuff properly with proper controls, proper protection devices, programming, monitoring, all that stuff. And then this is all done to keep the reliability up. That's what it really uh, allows for. That's why you have 99.9% whatever reliability. That's your expectation that when you flip the light switch, that the lights actually come on. We don't have blackouts. This is what we're possibly leading to if we don't see the investment, which many people in the industry have been warning for, years and nobody listened. Now, people are going to start listening because the price is going up. So I think this is the last slide. Spain was this place where they weren't really nuts with the renewables. I worked for a couple Spanish renewable companies, which was bizarre. It's really bizarre how these people operate. But anyways, in their home country, we saw the blackouts because they went nuts with the renewables. And then we see that I put it here in the slide, like fossil fuels saved the Spanish electrical grid. Um, which is inevitable, right? Because these are intermittent power sources. You just cannot get around with it. You're not going to be able to, the resources don't exist to build out the battery infrastructure sufficiently to have a 24/7 renewable system. On a small scale, maybe for an isolated area, maybe that's possible, but not in a large country or economy that's, People need to have power on all the time. It's just not financially or physically, prudent to do that. And so this is a Bloomberg article. It says Spain's gas use for power jumps 41% in first half on blackout. Spain's gas consumption for electricity generation soared 41% in the first half of the year, with the power grid relying heavily on the fossil fuel to stabilize the country's power network in the wake of a nationwide blackout in April. Combined cycle gas turbines were used, quote, as a reinforcement of electricity supply security, unquote, gas network operator Enagas said in its earnings report on Tuesday. Power grid operator Red Electrica has been relying on the steadier but costlier generation technology to enhance the system's reliability after its unprecedented collapse left millions of people without electricity for several hours. Quote, gas played a decisive role in restoring normality in Spain after the April 28th blackout, ensuring supply to all consumers, unquote, said Enagas chief executive officer. Combined cycle plants went from supplying about 5% of the electricity produced in Spain to 49% during hours that were critical for the country, he said. So there you have it. Fossil fuels are not going away. Fossil fuel generation is not going away. You're not going to run the world on renewables. I've said it before, case closed, not going to happen. I don't care what anybody says. They cannot demonstrate how that's going to happen. It's just, it's not going to happen. So I think that's where an opportunity is because, again, that's another area that's been underinvested. I think GE Verona had their earnings call this week. I didn't deep dive it, but again, gas turbine orders are up for a reason. Okay. And again, they're not going to go crazy like they did in the like late 90s and just expand production and get over their skis. Again, you're going to be waiting in line. I don't know what the backlogs are. I need to listen to the earnings call, but you know, prior to this, we're seeing this all across everywhere. I explained this to somebody the other day. It's like, we talked about U.S. shale rolling over. So where's the new frontier? Where's the investment going to go? What's going to go offshore? And so the opportunity there is that industry, the whole offshore support, drilling and support industry, whether it's drilling companies, whether it's offshore service vessels, whether it's the companies that supply all the subsea devices that you need that are highly specialized and heavily engineered, FPSOs, floating production facilities, all of this stuff. There used to be multiple players, multiple vendors. Now, because of the lack of investment over time and the over indebtedness of that industry, it's consolidated down to a small, maybe in some cases, two, three, or four players in any one niche of that. And so, as investment ramps up, okay, as investment ramps up, as final investment decisions are cleared, then you put your orders in. Backlogs are growing at these companies because hey, the industry atrophied so much because of the lack of investment, because shale sucked the air out of the room for the last decade. A lot of companies just went away. So now, as investment ramps up, the infrastructure to support it and absorb all that cash is going to be limited down to a few companies, and they're going to benefit tremendously. As a matter of fact, the companies that we have in the AIA portfolio are benefiting from that. We've been involved in that. Offshore drilling is not just, buying, Valaris or Transocean. There's a whole bunch of sectors there that are doing well, where you're seeing orders pouring in faster. Their book to bill ratio, meaning they're getting more business booked than they are currently doing. So um, I think you're going to see more of that. I think, especially if I think oil prices go up, which I believe they will over the next couple few years, I think that we're going to probably at some point make new all-time highs in the oil price, inflation adjusted. That would put us around $200 a barrel. Uh, I think that's a possibility over the next few years because of the underinvestment. And I think that it's going to be a tremendous amount of wealth created. And this sector is still completely off most people's radar screen. Been pounding the table on it. And so I think that, yes, it looks like, well, nothing's happening right now, or why isn't, the oil price going up? Look, nothing ever happens till it happens. And I think that the case is there. It's a sector that's been underinvested in. It's a required sector. U.S. shale's now rolling over. OPEC doesn't seem to have the excess capacity or extra capacity that everybody thought they did. And so if demand keeps going up, then you still have depletion there. Depletion is never ending. Okay. It's there every year. You put an oil well in, it doesn't pump oil forever. It goes through a cycle of increasing production, plateauing, then in decline. And that's the same for an oil field, a district, a country. And so we have to move offshore. And that's why the oil sands are such tremendous assets because the investment has already been made and now they're just harvesting the cash. Okay. Um, is it exciting like Nvidia or some of these other companies? No, it's not exciting. It's boring. You're just sitting there collecting cash. It's a boring, boring business, and you're sitting there collecting cash while they buy back shares and retire them, and basically waiting for the big payoff, the optionality that you have towards or for higher oil price down the line, and then cash out. So that's how I look at it. That's where I'm investing. And that's where I think the opportunity is, or one of the opportunities that I'm really focused on. Okay, guys, that's it for this week. Appreciate the support. Channel continues to grow. Substack subscriptions continue to grow. Again, we're the tortoise in this race, not the hare. The tortoise and the hare. The tortoise plugs along consistently, patiently, keeps going, doesn't stop, and wins the race in the end. And that's what I think. What I have found, to simplify it, is the best way to make money. Long term and to build wealth, which is what I'm in the business doing. If you want flash, pizzazz, excitement, there's plenty of folks out there giving that. But then again, ask yourself, can they do it through over several years through a market cycle? What's their track record? Uh, be careful out there because there's a lot of you're in shark infested waters, and when you're in this bubble, everything works. And so we have the tendency, and I fell into this before myself, of confusing luck or being in the right place at the right time with genius, and it's not the case. Okay, guys, that's it for this week. We'll talk to you next week. Thank you.